Welcome to Market Catalyst. I'm Julie Hyman. We are 30 minutes into the U.S. trading day. Let's get to the three market catalysts we're watching this hour. First up, President Trump imposes a $100,000 fee on H-1B visas. We'll discuss what that means for the tech sector and for the U.S. economy. Plus, Micron is set to report earnings in the next test for the AI trade. We'll have full coverage ahead. And investors are gearing up for a week of Fed speak and economic data. We'll discuss that and more on Market Catalysts. First up here this morning, let's take a look at what's going on with the major averages. We're seeing a little bit of a pullback, a little bit of weakness after the records that we saw last week. Right now, the Dow down a little more than 150 points, about a third of 1%. The S&P 500, little change the downside. The Nasdaq, however, has just peaked into the green a little bit. We'll see if it ends up staying there. Also wanted to get a check on the Russell 2000, which joined the record club after a long absence last week. But right now, we're seeing it pull back by about a half of 1%, so underperforming the larger cap averages. And we continue to watch what's going on in the bond market as well. It's been very interesting here. Just looking at a little bit longer term chart, we're seeing yields go down a little bit today. But if you look at the 10-day chart of the 10-year note, you've seen this move downward in yields leading up to the Federal Reserve cutting rates. And since then, we have seen yields move up a little bit, which has been interesting to watch here and sort of in line with the predicted volatility that we could see in the wake of the Fed actually cutting rates. Now, digging into what's going on in stocks a little bit more, we see a mixed picture here for the NASDAQ 100, but in particular, I want to point out Apple here. Apple shares actually going positive on the year, just barely up about 2/3 of 1% as we get the introduction of the new iPhone, and the reception coming from the analyst community and investors has been fairly positive here. We had a price target increase from Wedbush this morning, for example. Tesla also rising. We talked about that a little bit. President Trump shaking hands with Elon Musk as the two appearing in public for the first time in some months. And then we're seeing some strength within the semiconductor sector as well here. Not with the largest, right? NVIDIA and Broadcom are trading lower, but TSM, ASML is a higher. AMD, Micron ahead of those earnings this week. There's the year-to-date chart where it's seen just about a doubling on the day. It's up a little bit less than 1%, so that's something to watch. And then finally, quick check on the sectors in the S&P 500. Consumer discretionary continues its huge run that we have seen, along with communication services today. Now, it's only up about 1/3 of 1% today, but consumer discretionary on the year, we've seen it gain about 8%. It's been one of the better performing sectors. Consumer staples, on the flip side, are under pressure today. Well, President Trump announcing plans to impose $100,000 fees on H-1B visas. That's a move that could affect American tech companies, as well as ongoing trade discussions within India and China. For those who are not familiar, H-1B visas are designed for what are designated as highly skilled workers from outside of the U.S. to come in and work in the U.S. They're heavily used by the tech industry. Joining me now to talk more about the effect of all this, Henrietta Trace, Beta Partners Managing Partner and Director of Economic Policy. So Henrietta, it seemed as though there was initially a lot of confusion when this was announced. Now there's a little bit more clarity. It's a one-time fee, for example, not an annual fee. But we've seen more of an effect stock-wise on Indian companies than on U.S. tech giants. What are you hearing about how this is being digested?
Yeah, there's a lot of moving parts here. As you suggested, there was a lot of confusion as Secretary Lutnick came out and said that this was going to be an annual fee collected over 6 years, which would have been a material ongoing sort of persistent negative for what I think it's 71% of H-1B users that come from India. The bulk of the remainder come from China. But the negative hit of 6 consecutive years of $100,000 a pop would have been materially detrimental to India and migration over here. I think it's something like 86,000 workers per year that receive this H-1B visa. So it is a material negative for India. And what the administration has made clear, which is why some of the tech companies are being a little bit protected today and not responding in the same way, is that there were going to be licenses and exclusions and off-ramps for what you might assume would be the tech sectors that are closest to the administration and the CEOs there that are closest to the White House.
And Henrietta, as you mentioned, this also has implications for U.S. relations with India. This ahead of UN week here in New York, where global leaders gather. President Trump scheduled to speak tomorrow, presumably we'll see some maybe handshakes between Trump and Modi, who knows? But what are you sort of looking for and zeroing in on there?
Yeah, the U.S.-India trade situation is not good. Not only do we not have a deal with India, but the tariffs keep ratcheting up. Latest is obviously this H-1B visa situation. But prior to that, we'd had the Russia secondary tariffs imposed by President Trump at unilateral authority through the International Economic Powers Act, and basically saying, you guys are not negotiating with the United States the way that we want. We know that Ambassador Greer, the current USTR, has been very focused on India, not just in the second Trump administration, but also in the first, originally stripping them of their GSP status. And they have a lot of issues to work through. There are at least 3 phases of trade negotiations that they anticipated working on with India. And we're not even done with the first one yet. And it's October, or almost October. So there's a long way to go.
Henrietta, there continues to be this sort of a little bit of cognitive dissonance, it feels like, because talk to folks like you, there is still a lot of movement to be made in terms of trade. I mean, with China, too. Let's remember, yes, they talked on the phone on Friday, but the trade deal still actually needs to get worked out, and the details need to get worked out. We talk about stuff like H-1B visas. We talk about immigration and the effect on the economy. And yet here we are near record highs in the market. The economic data, by and large, seems to be holding up fine. Earnings seem to be holding up fine. So, what kind of conversations are you having with your clients who are sort of experiencing that cognitive dissonance, if you will?
Yeah, it really depends on who you talk to. So if you are exposed to the stock market, if you're making more than $200,000 a year, you are digesting these tariffs that amount to a $2,600 per household hit annually across the United States. But if you're rich, you can absorb that. It's the regressive nature of these tariffs. The fact that people on the poorest levels of income and even middle income are require those goods. They have to buy them. They're incredibly exposed to those items that are all being tariffed. And I would say that the tale of 2 sectors is really pretty incredible when you look at the stock market gains, but then look at job losses. I think it's something close to 80,000 jobs lost in the manufacturing sector alone since Liberation Day. America's soybean farmers are going bankrupt because there are no orders from China or anywhere else for our soy. And that's a direct result of the president's tariffs and the trade war across China, India, the EU, Indonesia, Vietnam, the Philippines, Canada, Mexico. It's global. So it really depends on where you work, what you're working in, and whether or not you already have a tremendous amount of income and are exposed to the stock market. If you are not already wealthy, you're hurting right now. You're seeing your money go less far. It's more expensive at the grocery store and at Walmart, and you may be losing your job. So it's really 2 different stories right now in the U.S. economy.
So, Henrietta, if you look at the polling around tariffs, they're not very popular, right? But I guess what are the political implications of what you're talking about? Are there any political implications? It doesn't seem as though this administration, they seem to feel very empowered to continue to push forward their agenda despite the political costs.
Yeah, it's really quite shocking. So this weekend, the president was at the memorial service for Charlie Kirk, talking about how popular the tariffs were and how they're bringing in unsubstantiated, tons of revenue to the United States. And then you ask the average American how they like tariffs and what they think their number one concern is going forward. 83% of Americans are telling you that costs are too high. These tariffs are very well understood by the American public, and we know that they are taxes. And we know that they are driving the cost of your sneakers up, and milk and coffee and steak, everything that you want. And it's really mostly felt in the manufacturing space, in the agriculture sector. And those are the people who voted for President Trump and got him over the finish line. And who was at Windsor Castle? It wasn't the farmers and the manufacturers, it was tech giants. And that's a massive disconnect between what the president is digesting and internalizing and then what he's feeding back to the American public, which is that the tariffs are great, they're popular, they're making America great again, when the average American would tell you, I don't agree with that at all. And so I think it's a massive liability for the entire Republican conference. And I'll illustrate it with one point. Speaker Johnson put a rule on the House floor last week that would protect every single one of President Trump's tariffs from being faced with congressional pressure through January of 2026. He said no votes on any of these tariffs because it's a political lead weight. And I think that's going to be a big topic of the midterm elections.
Interesting. There's one more other thing that is consistently unpopular. I mean, there's lots of things that are consistently unpopular. But one other thing that's probably going to happen or could happen is a shutdown, a government shutdown. And that is definitely consistently unpopular. What's the likelihood of that at this point?
We're definitely moving in that direction. I would say that while just a week and a couple days seems like a short amount of time to the average bear, it's actually a lifetime in DC. So what I would watch for if I was worried about a shutdown is whether or not members get called back into DC on Thursday. They're gone right now for the Rosh Hashanah holidays, but if they get called back early, that'll be a really clear indicator that Schumer and Jeffries are going to talk with the president. They're going to talk with Leader Thune and Speaker Johnson and try to cobble together a path forward. The one thing that I think substantiates this view that there will not be a shutdown is the fact that the defense appropriations bills have not passed. There's no protection for the agriculture sector. Republicans need a farmers bailout because of these tariffs and the potential bankruptcies that all these farmers are about to go through. So they would like members to come to the table and negotiate a bailout package of $30 to $60 billion. So we're a ways away from getting there. But the odds of a shutdown are very real.
All right, we'll keep talking about it, keep watching for it. Henrietta, always great to talk to you. Thank you.
Thank you.
Coming up, what the leadership changes at Oracle could mean for that company. We'll be right back. Oracle shares are slightly higher today. Now, there's a lot going on. The company did announce the departure of CEO Safra Catz. She'll be replaced by co-CEOs Clay Magouyrk and Mike Sicilia. Catz will shift to executive vice chair of the board of directors, so she's not leaving the company. And in the meantime, we're also getting more headlines on what the U.S. TikTok sort of deal is going to look like, which will almost certainly involve Oracle, perhaps in a very large way. Here to talk more about all of this, Ivana Delevska, Spear Invest founder and CIO. Ivana, you have a small position in Oracle in your tech ETF, SPRX. It has been Oracle's year in a lot of ways, but this Catz transition was a bit of a surprise. What do you make of that?
We weren't entirely surprised, Julie, because if you look at it, the company has been going through a lot of transitions over the past year plus. So it's not surprising that there would be management change associated with it. So between them trying to go after large cloud deals, this TikTok deal, I think there is a lot going on, and they're trying to set the company up for the next leg of growth. So the management team that will be able to do that may be different than what they've had in the past.
Gotcha.
So it makes a lot of sense.
Yeah, with that huge backlog that they have now to work through. And then I'm looking at some of the headlines and some of our reporter notes who are on the call now. There's a White House call detailing some of the details of the TikTok deal. And it sounds like, there is this consortium. There's reporting that Oracle is going to be really key in providing the security rails around this new TikTok. What does that mean, sort of in a material way for Oracle?
Well, I think it has two implications, right? So it's first a customer that they're going to be able to provide services to in a large way, but it also sets Oracle up as an example of a company that can do these types of things, almost like a lead case, right? So I think there is going to be more deals like this to come, not necessarily with Chinese companies, but even from the US companies where people will feel comfortable having their data on the Oracle Cloud and using AI agents on top of that data in a secure way.
So you, as we mentioned, you have a relatively small position in Oracle in the ETF. What would, I don't know what kind of criteria you're using, but what would convince you that it needs to be a larger position?
So we are actually looking at their enterprise business and trying to see how they can scale this to service their enterprise customers with AI agents. I think there is a case to be made on top of the large CapEx numbers, which I think investors were excited about. We're looking more from the angle of, can this be an asset-light business model that can provide AI agent type services to enterprises that already have their data on the Oracle platform? So I think it could be a pretty interesting story. There is still a lot of proving to be done, right? Because they dropped the ball in the prior cloud cycle, and now it's really at a point where you have so much innovation that they can kind of reaccelerate and gain back their share. But that's basically what would make us more comfortable if we see some progress on that front.
Interesting. All right, so something to watch for them. I want to switch gears and talk about another big tech story that we're watching, and that is Micron, which is set to report after the close on Tuesday. Last week, it had a 12-session winning streak that just ended on Friday. That was a record for the stock. So obviously there's some enthusiasm going into these earnings. Do you think they'll be able to deliver?
So Julie, they will definitely be able to deliver. The question is going to be, will it be above expectations? And as you mentioned, the stock has run up quite a bit. They pre-announced in August, which set the stage for a big beat that investors are expecting. So we're not involved right now for that reason. Expectations are a little bit ahead of where we think results will come in. But if you look at the broad data center landscape, everybody had blowout results this quarter. So I think any pullback would be an opportunity for investors to get involved.
Well, and it's interesting when we talk about the large cap tech landscape and how companies are monetizing AI. Even if it's not their main business. And Micron's an interesting case of that with its high bandwidth memory chips, because it is actually selling into specifically that AI market.
Absolutely, and I think what's even more interesting is that memory and networking is really where a lot of the performance improvement comes from. So this is why a lot of the networking plays are doing really well this year, and same as memory, where it's really a critical component in getting better performance out of the GPUs for the AI trade.
How do you think about semiconductors more broadly? Are we in a post-semi cycle world now because of AI? It used to be, for people who aren't familiar with semiconductors, I mean, it was a very cyclical business in terms of price and demand. Is that not something that semi investors have to worry about anymore in the same way?
So I think this is hardware will always be very cyclical just because of the way things get ordered and put into place. However, when you have such a strong tailwind and when you're so early in a secular bull market, right, what you see is these cycles really get softened out, right? So we saw with NVIDIA between the Hopper and the Blackwell architecture, there was a little bit of a pause, if you will, in terms of ramping one up versus ramping the other one down, right? But it wasn't big enough to even move the needle for their earnings, while usually you would see like down quarters. So we haven't really seen, even though we had a generation change, we didn't really see a pullback in terms of the numbers. So I think this will last. Because we're so early in the secular trend, I think will last for the next 2 to 3 cycles, and then you're going to start seeing a more pronounced cyclical trend.
And the top holding in your ETF is actually a company I'm not as familiar with, Astera Labs, which is a semiconductor-related company, I guess. That's a bigger holding for you guys than NVIDIA, for example. Why?
So we were really able to size up Astera Labs on the pullback going into the summer after all the people panicked from tariffs. So that's why it's such a large position for us. Right now, they're a critical provider on the networking side. So what we talked about with Micron and memory, they are a provider on the networking side, and they're really well positioned when they're gaining share from just being servicing customers like NVIDIA to multiple like Amazon and a lot of the cloud service providers directly. So they're growing their customer base and they're introducing new products, which is really making a step change difference for their earnings and revenue numbers.
Ivana, good to see you. Thanks for coming in. Appreciate it.
Thank you.
Thank you. Well, as we've been talking about, Micron is set to report earnings in what marks the next test for artificial intelligence demand. But what exactly does Micron do? It's a memory chip maker, and it's one of the best performing chip stocks this year. Founded in 1978 and headquartered in Boise, Idaho, Micron has grown into a global leader in DRAM. The company's growth is being fueled by high bandwidth memory, also known as HBM. That consists of bundles of DRAM chips, which are closely connected to processors from NVIDIA and vital for AI computing. Now, what's DRAM? Well, that stands for Dynamic Random Access Memory. It's a specific type of RAM, or random access memory. All computers have RAM. DRAM is one kind that we see in modern desktops and laptops. Its main competitors in that DRAM segment, Samsung Electronics and SK Hynix, both of them are based in South Korea. Micron plans to expand in the U.S., announcing in June it will spend about $200 billion on U.S. manufacturing and research and development. The R&D spend, along with strategic partnerships, have positioned it as a key player in the semiconductor space. We got much more markets action ahead, including some other trending tickers for you. You're watching Market Catalyst.
Welcome back to Yahoo Finance. I'm Brick DePalma. We are live at the NASDAQ here in Times Square. Let's turn now to some of today's top analyst calls on Wall Street. Brinker, Apple, and Keurig Dr. Pepper. Let's start here with Brinker International. We saw shares enjoying a small pop at the open a bit there after Wells Fargo upgraded the stock to overweight from equal weight. The analyst there believes Chile's parent companies, which is Brinker International's fiscal year 2026 same-store sales growth and earnings forecasts are beatable, and that management excluded confidence in growth levers like certain food, including the relaunch of queso as well as ribs. In addition to that, marketing and tech initiatives. It also raised its price target to $175. Right now it's at $138. And Apple stock rebounding into positive territory for the year. That's after the iPhone maker got a price target upgrade from Wedbush to $310, up from $270. Right now, the stock's sitting at $252. Analyst Dan Ives said it was based on early strong demand signs coming out of that iPhone 17 cycle, which officially went on sale over the weekend. He said, quote, "We are positively surprised on the demand trajectory with units that now appear to be tracking 10% to 15% ahead of the iPhone 16 so far." He did caution, though, that China demand will be a, quote, linchpin to the upgrade cycle. And last ticker here, Keurig Dr. Pepper, ticker symbol KDP. That stock moving lower this morning after BNP downgraded the stock to underperform from neutral. The analyst there said he sees risk to earnings, deal risk after the acquisition of the Dutch coffee company JD Peet's. That's expected to close in the first half of 2026, as well as credibility setback weighing on KDP's multiple. And that's it. That's keep it here on Yahoo Finance. We'll be tracking all the latest market moves throughout today's trading session.
Now time for some of today's trending tickers. We are watching Oracle, Compass, and BYD. First up, Oracle. Aside from those C-suite changes we've been talking about, we're also getting updates on its role in the TikTok deal. U.S. officials say President Trump will approve that deal this week and say Oracle will study the TikTok algorithm to be retrained in the United States. The TikTok deal will close 120 days from its signing. ByteDance will hold less than 20% of the U.S. TikTok operations here. We're continuing to monitor headlines from a White House briefing regarding that deal. Next up, Compass. It's agreeing to buy Anywhere real estate in a $1.5 billion stock deal that would cement Compass's status as the largest residential brokerage in the U.S. The deal would give the combined company an enterprise value of roughly $10 billion, Compass said. When it closes, current Compass stockholders will own about 78% of the company. Anywhere investors will hold roughly 22%. Compass secured a commitment for $750 million in financing from Morgan Stanley. As part of the deal, its shares, by the way, are down about 9%. Anywhere shares, as you might imagine, are surging by about 58%. And finally, BYD. Hong Kong-listed shares of the Chinese EV maker closing down by more than 3% today. That's after a report from CNBC that Warren Buffett offloaded his stake in the company. Buffett's firm held the stock for more than 15 years, having first bought 225 million shares back in September of 2008. BYD shares have tumbled about 30% from the all-time high reached 4 months ago due to growing concerns over its ability to fend off competition amid a destructive price war in China. And you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Though the Fed's September rate cut could be good news for homebuyers. Sotheby's International Realty Global Real Estate Advisor Jenna Stauffer spoke to Yahoo Finance's Miles Udlin about what it means for homebuyer sentiment.
All right, well, the Fed's September rate cut and 5 straight weeks of mortgage rate declines are giving buyers a little more breathing room, but affordability remains at its worst levels in decades, with high prices, taxes, and insurance still weighing on the U.S. housing market. For more, we're bringing in Jenna Stauffer, Global Real Estate Advisor at Sotheby's International. So Jenna, I know one rate cut won't fix everything for the housing market, but are you starting to see, as rates have come down in September, have you started to see signs of buyers getting a little more comfortable, being a little more willing to step in after things were really frozen there for about 18 months or so?
They absolutely were frozen for about 18 months or so. And look, the housing market is so sensitive to any interest rate changes. So when you do see interest rates go down, you do see purchase applications pick up. You see activity pick up. So we have seen some buyers come off the sidelines. It was nice seeing mortgage rates come down. Now that we do have a rate cut, we don't know exactly what's going to happen with mortgage rates, but I do do expect mortgage rates to continue to ease. It might not be in a straight line. It's going to be really dependent on data that we get and if economic conditions can really align.
Now, the sticker price on the house is one thing. When you talk to prospective buyers, are things like the rising costs of home insurance, particularly in markets like Florida, are these things becoming more prominent in those conversations? Because it seems like for a long time, it's like, well, okay, house costs X, mortgages Y, I can or cannot afford that. But these other pieces of the puzzle now seem to be playing a larger factor in the caution we've heard from a lot of buyers.
Absolutely. So it's what I call this lethal combination. This lethal combination has really been holding so many buyers back from being able to get into the housing market. And what's in this lethal combination? It's, of course, the high home prices relative to income level. It's the elevated interest rates. It's rising maintenance costs. It's rising insurance. It's rising taxes. Look, affordability is a big issue. It's really this choke point that we just continue to hit. So it's not really one factor more than the other. It's the combination of all these factors.
I think a lot of the conversation we have around the housing market is around the challenges for buyers. I'm curious your view on the challenges for sellers. Are you hearing from folks who don't want to be in the market because they want a certain number, they don't think they can get it, they don't want to have their home sit? Like, what's the seller mindset in this environment as well? Because I think when both sides of the equation don't feel great, it feeds on itself. And that's, I think, why we've seen conditions in the housing market be so challenged for so long.
Absolutely. There's been this mismatch of expectations and reality. And you do have sellers that are discouraged with this housing market. It's been a tough pill for some to swallow. They're not seeing in some markets the price increases, these rapid price increases that they had been getting used to. So they're having to adjust to the market. And for some sellers, they're in a position where they don't have to sell. So they are pulling their listing. You're seeing delistings really pick up. That is a big thing. We have seen an increase in inventory this year. So that's been putting this downward pressure on price growth. Prices have gone up tremendously. So even when we see this deceleration in price growth, homeowners are still sitting pretty. They're sitting on record equity, but in their mind, they're still back in these 2021, 2022, and they're not really in line with current market conditions.
Goodbye or goodbye. Our goal, to help cut through that noise to navigate the best moves for your portfolio. I'm here with Todd Sankwitz, the Free Markets ETF portfolio manager, to talk about a couple of plays today. So Todd, let's start with Doximity. It's a name that you are bullish on. We're going to start here just taking a look at the chart and thinking through what's just the overall setup that you see, with this name.
It's very interesting with this name because this was an actual real decision we had to make not too long ago when the One Big Beautiful Bill was passed, and that made permanent the telehealth safe harbor. Mm-hmm. So essentially, Doximity really has a strong competitive moat.
Yep.
What we're looking at with Doximity is that they have 80% of the physicians on their platform, and they are very unique, and you don't have a really lot of the competition right now with them.
And I'm just curious, in a vacuum, how deep is that competition for, provide the companies that are helping me find my way to my doctor via the phone? Because obviously not something I was probably thinking about doing 10 years ago, but now is more or less the default way I could ever get in touch with the physician.
Yeah, so it's very interesting because the way to think about Doximity is it's kind of like LinkedIn for doctors.
Yeah.
So it's a technology platform that's allowing doctors to connect, communicate, and share information.
All right.
So really that's what that's about. When we look at the stock.
I jumped ahead. We'll leave that there.
We may be having a different conversation.
That's right. We'll leave that there. All right. Sticking with Doximity then, let's talk about the financials and what you kind of see when you go through the income statement and the balance sheet there.
Yeah, exactly. So here we're looking for a company first and foremost that really doesn't have a lot of debt. It's pretty much de minimis for this kind of company. And what we're seeing over time is we're seeing very strong revenue growth, expanding margins, and we're seeing a company that's really about responsible financial growth, right? Mm-hmm. But at the same time, they're kind of exploding within their space. So that's I think a very strong point for Doximity right here.
All right, and then talking about the mix of revenue, and I think when it comes to healthcare, there's, the theory always sounds great. Oh, there's so many ways to, kind of make the healthcare system cleaner, but huge regulatory burden. So how, when you look at Doximity and where it fits in there, what that setup is for the company?
This is what I love about Doximity, because they really don't have a whole lot of regulatory burden, which seems kind of counterintuitive when you think about investing in a fund that's going to benefit from deregulation. Because really what happens at the end of the day, Doximity is sitting at the intermediary, right? More of a technology company in the healthcare space. So what they're doing is they're providing that facilitation. So they're giving doctors a way to communicate with patients, a way to communicate with each other. They're integrating with electronic health record companies and things of that nature. And they generate a lot of revenue, just like we see with a lot of social media organizations through advertising, particularly with drug advertising to doctors. So that may shift a little bit, but at the end of the day, they're not subject to regulation themselves, but they can benefit from telehealth rule relaxation so that they're better delivered, so doctors can better deliver that to patients.
So even though they're kind of dealing with, doctors' communication, et cetera, like they're not sitting there saying, like, we ourselves have a major, HIPAA issue around those kinds of communications. That sort of stuff tends to sit, with the care providers?
Exactly, yep, they're the facilitator.
Great. All right, let's move on to another name. Let's see. To a name. Oh, we have a risk. We have a risk. We have a risk. First time. We have a risk. All right, let's talk about all the things we liked, something we maybe don't like about Doximity.
Yeah, I think really when you look at Doximity, it's been priced to perfection. It's trading at a very high forward PE ratio of about 61. And so if you see healthcare organizations reallocate those budgets to electronic health record organizations, and they have direct communication platforms, so if they shift a little bit, that could obviously cause the stock price to decline, because we're going to see that valuation adjust really quickly.
All right, let's move on to a name that we like a little bit less, maybe a good buy in the portfolio, and that is Teladoc. I kind of teed up their business model, getting the two confused here. We see the chart, doesn't look like the most constructive thing I've ever seen. When you think about a company like Teladoc, where do you start with not liking this stock?
Yeah, so Teladoc is actually the healthcare provider, right? So telehealth provider. So really at the end of the day, what we're seeing is a lot of competitive pressures within this space, and so we see more people moving into this. So in fact, deregulation, where it could benefit it could also affect companies like this who are directly tied and delivering that healthcare, because more entrants can move into this space easier.
And then when we look at the problems that they have on their financials, when you look at their income statement, their balance sheet, what stands out to you that you don't like around the Teladoc story?
They're way down by debt. They have a tremendous amount of debt. They have very high interest expenses, and they really just aren't growing. And those competitive pressures are a primary reason. As more people move into this space, there's more players to basically contract with from a telehealth perspective, and these guys are suffering from it.
So it's a little more like, it sounds like a tech play, but it's actually a medical play, and then the financials of a medical play are not going to quite be what people think they're signing up for.
Yeah, and what you're going to see really with the third point here is exactly that, because when we look at the third point, right, their deregulation can give them a lot of leverage, but at the same time, we have a lot of reimbursement risk. And this is not something that's unique to telehealth. Right. This is something that's happened across medical care in general, right? As health insurers are being more critical of basically what they're reimbursing for and what services and what's being charged, this is an ongoing risk. So it's not unique to telehealth, this is unique to healthcare in general.
Yeah, I mean, I know, the story obviously has a lot of other complications to go with it, but United Health is coming out every quarter just saying, well, more people are using our services, and that's a major problem for them. And so, yeah, you're right. The more you move into that space, the more you bring those on board yourself. Now, possible upside here for Teladoc, maybe something that could turn the story around in ways that are different from how you're seeing it today.
Yeah, so they're leveraged to regulation, so obviously more favorable regulatory environment is going to be great, which I think is what we're in. So I think that's a tailwind, but unfortunately, I think their debt is a huge burden to them, like we spoke about. Now, if they could successfully restructure that debt and they could reduce that interest cost, I think that this could allow that company to reinvest that money and potentially grow and turn this story around from a bear story to a bull story.
All right, well, they'll stay locked in on what Jay Powell does over at the Fed on that basis. All right, Todd, appreciate the time.
Thank you.
And that's it for Goodbye or Goodbye.
The Federal Reserve mapped out several potential rate cuts through the end of the year. That's the easy part. What's more complex is balancing those cuts with an uneven labor market that could include an unemployment rate shooting higher. That's a trend often seen during downturns. With us to explain how the Fed will try to thread that needle is Michael Darda, Roth Capital Partners chief economist and macro strategist. And by the way, that's at a time when inflation is not really coming down, Mike. It's good to see you. Do you think that the Fed has made sort of the right calibration in focusing more now on the risks to the job market than the risks to inflation?
You know, Julie, I'm a little bit more worried now than I was a year ago. I thought there was a pretty strong case that the Fed was at risk of falling behind the curve. So I supported the 50 basis point cut out of the gate and the two follow-up 25 basis point cuts that the Fed executed. But if we look at where financial conditions and inflation expectations are today relative to where they were a year ago, inflation expectations are actually higher by 40 to 60 basis points at the 10 and 5-year horizons. And financial conditions, credit market indicators are actually looser, more growth supportive than they were a year ago. So I understand what the Fed is doing here, given the slowdown in job growth that's gotten them worried. But I am a little bit more concerned that they potentially ease too much and, are not able to re-achieve their inflation target and we're already, they've already overshot it for 56 consecutive months. And the SEP, the Fed's own forecast, don't envision on-target inflation until 2028. So, this overshoot is getting very long in the tooth, and I just worry at the margin that the Fed could end up easing too much here and then overheating the economy next year.
At the same time, Mike, I have questions about the Fed's ability to influence these things in the economy like they once did. I mean, we're looking at financial conditions that are already relatively loose, even though Fed policy is tight, for example. So is there a sort of muted effect right now on Fed policy and how it works its way through the economy?
Well, I think the Fed is still quite powerful. And keep in mind, they did drop the policy rate a full percentage point last year. And that helped to buoy inflation expectations, which started to roll over really hard last summer going into the fall. And it's also kept financial conditions, quite growth supportive. So the Fed has successfully engineered a soft landing so far. So if they do that, the obvious risk of recession recedes. The other tail is the risk of overheating. And so at the margin, I think that is a bit more of a threat here, because I do think the Fed appears to be locked into this easing cycle, albeit probably somewhat slower than what the market has priced in here. Also, if you look at tracking estimates for the economy for the third quarter, real GDP out of the Atlanta Fed is still tracking above 3%. And real final sales to the private sector, 2.7%. The GDP deflator is probably going to be close to 3% in the third quarter. So if we're running close to 6% nominal growth, it just might be that the neutral interest rate is a lot higher than it was in the last cycle. So the Fed really isn't that restrictive. If we hearken back to the equation of exchange, nominal GDP is just the right side of that equation. Money times its velocity gives us prices times output. So strong nominal GDP growth tells us the Fed's not really in a restrictive stance here. And so they shouldn't seek to ease policy in a way that makes them accommodative. That would be a mistake. Staying neutral is really the key here, and that's going to be a difficult balancing act.
Mike, how do you think the economy has held up so well, and defied a lot of predictions to the contrary?
Well, I think it was just a matter of, this business cycle upswinging being much more intense, a legitimate V-shaped recovery that also came with a lot of inflation. And so the Fed started off way behind the curve. And then to their credit, they caught up. They were delivering 75 basis point rate increases at a time which I don't think anybody envisioned, all the way back in early 2022. So, they took the risk, taking rates up 500 basis points that they might overdo it and cause a recession. But that didn't happen. And I think it didn't happen because the Fed got lucky to some degree in terms of the timing and magnitude. We also had some gifts that arrived just on time with the supply side of the economy reviving after 2022. So productivity growth picking up, a surge in immigration that helped to thaw the labor market a little bit, which was overheating. And that helped the Fed to engineer this soft landing. But, they needed to get rates up. They succeeded in getting rates up, but they didn't tighten enough to crash the economy, which is typically what happens.
Right.
So, so hooray for the Federal Reserve, because these are really rare historically. I mean, you can maybe, find one or two instances where the Fed did sustained monetary tightening and then didn't overdo it to the point that they threw us into a downturn.
I'm curious about some of the fiscal policy risks that remain. I mean, it seems like tariffs, it's not the all clear on that, but now we have the H-1B visa confusion. Is that an economic risk in your view?
Yeah, I do think it is. I mean, longer term, we are dealing with demographic headwinds. And so your growth potential, the supply side of the economy, is simply the sum of trend productivity and the growth rate of the working age population. Because of weak demographics, organically, we're pretty close to zero. And so all of that growth is going to come from immigration. If immigration's effectively shut down, that's a headwind to the supply side of the economy. So hopefully, in time, policymakers can figure something out that looks more like a happy medium. Obviously, you can't have just a completely wide open border and total chaos. But at the same time, a shuttered border and overly restrictive immigration policies are also a headwind, and we're more in that direction now.
Mike, always good to catch up with you. Thank you so much. Appreciate it.
My pleasure.
Coming up, we'll have full market coverage ahead in the second hour of Market Catalyst. Don't go anywhere. Coming up this hour on Market Catalyst. First up, Citi downgrades Intel after the chipmaker secured a $5 billion NVIDIA investment. We'll speak with the analyst behind the call. Plus, we'll break down the outlook for markets in the fourth quarter with stocks pulling back from records. And in today's Investor Playbook, we'll bring you the outlook for software stocks. Is there a bubble brewing? We'll discuss. 90 minutes in the start of U.S. trading. I'm Julie Hyman. Let's get a check of the markets here as we do have now things turning a little more positive. So any gains today, we'll see more records for the major averages, but we have seen some volatility in recent days start to creep into the equation. Right now, the Nasdaq's leading gains up 1/3%, the S&P up about 1/5, and the Dow peeking into the green as well, up 26 points at the moment. Well, shares of Intel went on a tear after NVIDIA announced a $5 billion investment in the company. That partnership will include a collaboration on PC chips and data centers, though it did not include any details about Intel's foundry business. One analyst less enthusiastic than the price reaction would have indicated. Christopher Danley, Citi head of U.S. Semiconductor Research, downgraded the stock to sell, raised his price target, though, to 29 from 24. And he's with me now. Chris, it's good to see you.
Thanks, Julie.
So obviously there was a lot of enthusiasm after this happened. But really the question was, is it a buy? Does this make it a buy after this happened? You come in and you emphatically say, no, it does not. What is the main reason why it's not?
Sure. So I really don't think that any of these three sort of actions that came out are going to amount to much. The easiest one to quantify is the $5 billion investment. Okay, that's fine. You get some cash. The second part is Intel is going to integrate NVIDIA graphics into its processors for laptops. Okay, we all know that Intel is sort of behind AMD in terms of microprocessors. And if you look at the sort of ability or judge the ability of a processor or microprocessor, the graphics chip or graphics capability really doesn't have much to do with that. So A, they have to be able to integrate it. It's not their technology. That's going to take at least a year and a half. And B, even if they do, we really don't think that changes the competitive dynamics. And then the third part, where we actually think it's going to work somewhat, but not move the needle much is NVIDIA is going to integrate Intel processors into its AI product offerings. Okay, sounds good. So what's going on there? So this is primarily aimed at the Grace product that NVIDIA offers. This is sort of like a low-end AI product, right? Not very successful at best. This thing is generating 3 to 5 billion in sales per year, which sounds good, but that's the processor plus all the the goodies that go around it. So if you look at the processor itself, that's max 1 to 2 billion. Right now, that's only being offered with ARM processors. Now they're going to offer some Intel processors. We think that, okay, fine, this is probably going to work. Intel's probably going to get some business like this. Maybe it's 1 billion, maybe 2, 3 billion max, several years out. And Intel's a 50 billion plus company, so doesn't really move the needle in our opinion. And the main problem here, like you hinted about, is Intel continues to lose billions in this foundry offering, and we think that if anything, this sort of keeps Intel in this foundry product that continues to lose billions. And we don't like any of our stocks to lose billions of dollars on anything. So that was the gist of why we pulled the plug, is that it's going to probably keep them in the foundry efforts. People, investors are getting excited that they got NVIDIA now, they're going to sign them to a foundry deal. We think nothing could be further from the truth. Intel's essentially light years behind the competition. The stock's up 50% in the last 6 or 7 weeks. Part of that is on speculation of this deal. Part of that is on the deal. We just don't think that $30 the stock is going to generate, I don't know, maybe $1, maybe $1.50 in earnings max. You're talking, 20 to 30 times. It's time to, as Marv said in Wall Street, take the money and run on this.
Yeah. So to dig into the foundry question a little bit further, given that there has been such a push by this administration to beef up the homegrown chip manufacturing industry, which, as we know, doesn't really exist here in the United States, does that provide, if not a reason to buy, does that provide a floor to Intel and maybe some kind of long-term thesis for the foundry business?
Well, that's a great question. I'll take that in 2 parts. So the floor for the stock, we've said for a while, is about 1 times book value. We did raise our price target. Why did we raise our price target? Because Intel is getting cash, not just from the NVIDIA investment, but from the government, selling Altera, blah, 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 right? They're going to get about 17.2 billion in cash. And naturally, that's going to raise their book value. So we did take our price target up because we think, 1 times book should be about where the stock can bottom. The problem is that book value is lower than $30 or 29 and change, or wherever the stock is trading this morning. Hence the sell recommendation. So I do agree that there's some sort of value or a floor there, but not where the stock is right now. Now on the foundry side, we get a ton of questions from investors. Is the government going to coerce, cajole, force, whatever, other companies to adopt Intel's foundry business? The basic problem with that thesis is that Intel's what we call the merchant foundry business, right? Remember, there's 2 parts to foundry. Intel doing chips for themselves, that's under their foundry business. But more importantly, the one that everybody's betting on is Intel doing chips for other companies. These chips don't exist, right? So Intel's trying to be a leading edge foundry competitor to Taiwan Semi. They don't have anything. Like, you can't force people to use something that does not exist. And they're at least, 2 to 3 years behind Taiwan Semiconductor for leading edge chips. And they've been 2 to 3 years behind Taiwan Semiconductor for, a decade, 2 decades since they launched this effort. So there's still, there's no product. I mean, it would be like forcing you, Julie, to drive a car, and I'm going to take all the tires off of it. You're probably not going to go anywhere with this thing. It's the same thing with the government sort of forcing. So in our opinion, TSMC, they're building a bunch of fabs in Arizona. Just focus on TSMC and the Arizona effort, and we are going to have leading edge manufacturing here in the U.S. at some point. It's not going to be Intel, it's going to be Taiwan Semi.
Okay, so if you don't think Intel is ever going to win in that business, what happens to that business? Do they just convert it to making their own chips? Do they sell it to someone? If they did, who would want it? Like, what happens to it?
Yeah, good question. So again, I'll reiterate that there's like 2 parts to Intel's foundry. There's the foundry that they do for themselves, which we think is fine. They should stick with it. Actually, that business has gotten much better. That business was 2 years behind TSMC. By the end of this year, Intel's microprocessors should be, a couple quarters behind TSMC, right? Like 6 months. So there's improvement there. Now, on the other side, chips for other companies leading edge. I mean, there's essentially no business. They do some, manufacturing for the government, but it's nothing, right? So there's no real issue to getting out of that business. I mean, they did do some, sort of private equity investments, right, with Apollo and Bain Capital. So you'd have to work those things out. But, I think that was a couple billion, and you just got 17.2 billion. So just pay those guys off and say, thanks for playing. But yeah, there's nothing to close down, right? You just kind of hand the keys to someone and walk away. And the best part is you stop spending on it, right? So you go from billions of losses to a minimal loss, and whatever the earnings estimates are, probably going to go up by $1 or $2 just by not spending on this business.
Right. Well, we'll see if they end up coming to that conclusion and how much pain there will be between now and then. We'll see, Chris. Thanks so much. Really appreciate it.
Anytime. Nice talking to you, Julie.
Coming up next, we'll open up the investor playbook for navigating the next several rounds of expected rate cuts by the Fed. Stay tuned. You're watching Market Catalysts. The Federal Reserve signaling potentially 2 more interest rate cuts before year's end. That comes in the face of stubborn inflation and an unstable labor market. So what's the fourth quarter playbook for investors? Joining me now, Willem Sells, HSBC Global Private Banking and Wealth Global CIO. Willem, it's always good to get some time with you. You guys just came out with this playbook of what to do in the fourth quarter, but I guess we should take a step back and talk about the most important inputs, as you decide what strategy is going to be. Obviously, the Fed is one of them. What else are you considering and weighing right now?
Well, the title of our fourth quarter investment outlook is Riding the AI Liftoff and Seizing on these Fed rate cuts. So I think those are the 2 principal drivers. And that, of course, means that we continue with this bullish stance on global equity markets, on the US, and continue to invest. I do think also, the pickup in M&A, the dividend, payouts, the share buybacks, and so on are positives as well. So I think, stay in the market. That doesn't mean you don't need to diversify. Even bulls need to diversify. But I do think, when people diversify, it makes them more likely to stay in the market. So another reason to do so.
What do you think is the biggest risk going into the last part of the year?
So clearly, the economic data are going to be quite volatile. The different parts of the economy are going to, react in different ways, are going to have different timings in terms of when they see a little bit of weakness or a little bit of strength. So it's going to be quite confusing. The Fed as well, obviously, you've seen it after the meeting in what they call that dots chart. So the forecast from Fed members themselves as to where interest rates are going to end up. There is disagreement between them. So you're going to see a lot of volatility in the economic data and in the rate forecasts. But stick to the plan, keep your eyes on the price, on that AI, innovation, as well as the fact that the Fed seems to be determined to, ease policy from that restrictive level. So if you have growth that is holding up, earnings that are holding up, and the Fed cutting, it's a positive outlook.
So let's sort of dig into the playbook a little bit and some of those individual points. I know one of the things you're recommending to investors is add to quality bonds. I guess I would ask how you're screening for quality, but also, are you concerned at all about the duration and magnitude of the move in the bond market? In other words, I've talked to some investors who have said that the bond yields will only move down so far if there is still something of a concern about growth, for example.
Yeah, so we are overweight on quality bonds, and quality, since you ask, is mainly investment grade. So we think that the spreads in the high yield market are quite tight. There are some opportunities in the emerging markets, especially as they are able to cut interest rates as well, in part because the Fed is cutting interest rates and also because the US dollar is somewhat weaker. So there is less risk for emerging markets that by cutting their interest interest rates, that they weaken their own currency as the US dollar is falling itself. So that's where we are in terms of bonds. I do think in terms of duration that the 7 to the 10-year part of the curve is attractive to a very large extent because of that pickup in yield. We don't think that yields are going to drop very far. So basically what you want to do is you want to lock in an attractive level. And we think that the 7 to 10-year parts of the curve is attractive. Lots of clients that we talk to, are finally seeing those rate cuts and finally feel that they need to do something with that cash. And bonds is a first step into the investment market.
Gotcha. Sort of transitioning out of the period that we have been in terms of the rate cycle. When you talk about capitalizing on the AI cycle here, adoption and monetization, the devil's in the details for these things. It's work to sort of buy everything, right? Everything that's related to AI, I guess. Is that going to change? And, do you share any of the concerns that are floating around out there about some of the valuations and possible bubble in some of the AI-related trades?
Clearly, we get more clients' questions around that in terms of valuations. That being said, I do think this is a structural move. I wouldn't take profit too quickly on this. I think those valuations are still, inflating. And indeed, we do diversify across the ecosystem. So, that means the, automation, for example, that means security, that means infrastructure and so on. That allows you to have a broader set of opportunities, with better valuations. I would also encourage people to look beyond the US. We are seeing, the Chinese tech, picking up quite substantially. It's one of the markets that has done the best, over the last month or so. Clearly, technology that is quite impressive at much lower valuation. So by widening that scope, you can stay in the trade at somewhat better valuations. Clearly, this is also a stock picker's market. So don't just listen to me, but also at your analyst who is going to pick the right stocks. But clearly, the thematic remains in place and people should be exposed to that AI.
And finally, you also recommend investors mitigate possible currency and portfolio risk, which you touched on a little bit talking about the dollar earlier. And you also touched on by talking about diversification, which I imagine is one of the ways that people should mitigate that risk. Well, how else should they be thinking about it?
So diversification to some people sounds unexciting and feels like, I'm going to give up on returns. You can think of it in another way. It is broadening the opportunity set. So what we're really looking for is things that we like outside of technology, but that are also going to perform in other circumstances or even address some of the risks that you're seeing. So for example, those quality bonds gives you that income, gives you the hedge against a lower growth environment, but obviously doesn't work in case of higher inflation. So where do you go when you have higher inflation? It's gold, it's infrastructure. Higher income you can get, in private credit, in infrastructure as well. Lower valuations, as I said, you can get in China, or you can get them in financials and industrials, who are two sectors that we like as well. All of those areas give you opportunities. There is no one single area that protects you against all of the risks, that gives you all of the benefits, but it's by broadening that opportunity set and by diversifying in all of them that you construct a portfolio that will be more resilient, which will keep you in the market. And I think that is really what is important, to stay in the market and to not take profit too quickly.
And still keep it from being boring and getting some returns in those various investments. Well, great to see you. Thank you so much.
Thank you for having me.
Coming up, we've got some of this morning's trending tickers, plus the rise of Opendoor. We'll be right back.
Welcome back to Yahoo Finance. I'm Brooke Palmer. We're live at the NASDAQ in Times Square. Let's get a quick check on the latest market action. We're about 2 hours into today's trading session. We've seen all three major indices reverse to the upside here with green across the board. The NASDAQ leading that momentum up nearly 0.3%. That's followed by the S&P 500, which we heard from Goldman Sachs raising their price target for year-end to 6,800. So some bullish testimony there. And the Dow up nearly 1%. 0.1%, lagging behind the two other major indices as investors really wait for the Fed's preferred gauge of inflation, the PCE report set to come out on Friday. We're also set to get speeches from new Fed Governor Stephen Byron in just a few moments, and also Jerome Powell. He's set to speak tomorrow. Also, we're hearing more hints of further easing, or rather, we're looking for more hints of further easing, with projections that the Federal Reserve will cut interest rates two more times this year. Now, also, I do want to take a look at gold, because based upon this, we are seeing some momentum in gold as expectations for the Fed to cut further is into play here. Right now, gold has seen quite the run year to date as investors really sought out safe havens in this year's volatile market. Gold up more than 40%. That's its best year since 1979. A weaker dollar has also powered that momentum behind gold. Also trending today, some interesting points there, because we are seeing Pfizer moving higher this morning, up about 2% after they announced that mega $4.9 billion acquisition of Metsera. That's also a top ticker. Really momentum there around Pfizer's play within obesity drugs. And also Oracle getting a bit of a pop here, even more momentum now into midday trading session. Oracle up about 4% after they announced they're promoting their president of cloud infrastructure as well as their president of industries as co-CEOs. The current CEO there will stay on as executive vice chair of the company's board, but that stock has seen quite the run, up more than 90% over the past year. And lastly, I do want to take a look at Bitcoin, because we are seeing a major sell-off within cryptocurrency this morning. Most crypto assets seeing red this morning. Within just since Sunday evening, we have seen the market cap for all crypto assets fall about $4 trillion as investors really seek out more safe havens, perhaps going out of these more volatile plays. As you can see there, Ethereum down nearly 7% after quite the run up over the summer, and Bitcoin down nearly 2.5%. But once again, taking a step back, we are seeing green in all three major indices this morning as we make our way 2 hours into today's trading session. But keep it right here on Yahoo Finance. We'll be tracking all the latest market moves throughout the session.
Now time for some of today's trending tickers. We're watching Apple, Teradyne, and Netflix. First up, Apple. Those shares are climbing back into positive territory for the year, nearing a record high. For more, I'm joined by Yahoo Finance's Ali Canal. This is, we know Apple has been one of the Mag 7s that hasn't quite recovered from some of the lows that we saw back in the spring. So it looks like the new iPhone cycle is getting it there.
Yeah, in a lot of ways it was better than feared. Going into this cycle, we've talked about it, not a ton of excitement. It feels like investors really want to see more on the AI side of the story for Apple. But the fact that we are having these early reports that demand is there, that's an encouraging sign for this company. So I would say better than feared in a lot of ways. Now we're inching closer and closer to record highs. We are now up around 2% for the year. But I mean, if you compare that to the big tech peers, your Microsofts, your Nvidias, they're up 30% or more on the year. So it just feels like there's still a lot more to go here. There's a lot more to this story for Apple, still underperforming the S&P 500. But the demand side of the equation is certainly notable. And Bank of America was out with a note saying that analysts who track iPhone 17 demand, they said that ship dates remain more extended than last year, especially in China, where government subsidies are boosting sales of the base model. By contrast, the higher end Pro and Pro Max models have normalized timelines similar to prior years, while the new iPhone Air is the most readily available. I don't know the Air, how that is going to perform relative to some of these other models, but the fact that there are more options, the fact that we're seeing the demand, obviously boosting shares a bit.
Yeah, and also I noticed Dan Ives over at Wedbush, I think he's now has the highest price target on the street for the stock at $310. He just raised it today. And again, it has to do, he says, we've been positively surprised on the demand trajectory. And he says units appear to be tracking 10 to 15% ahead of iPhone 16 thus far.
And Bank of America did say they are bullish on Apple over the long term due to the potential as a leader in AI at the edge. So it maybe is one of those things where we need to be patient with this company, especially at a time when we're seeing instant gratification from a lot of these other companies.
True. Yes, good point. All right, let's also talk about Teradyne. The chipmaker getting a price target boost over at Susquehanna. We're actually seeing the chip stocks in general do relatively well in today's session, but Teradyne's up 9%.
Yeah, and it's part of this AI supply chain, and the bullish call is tied to GPU wafer sort testing. And I had to look this up, Julie, but it's a step where chips are tested right on the silicone wafer to weed out defects before they're cut and packaged. So it's essentially quality control for GPUs, and it makes sure the processors that power AI workloads are reliable. So a very important part of this process. Now, Susquehanna is saying that Teradyne is gaining meaningful traction with TSMC in this space, calling it an incremental positive that isn't fully reflected in the stock. And even with today's rally, their new target implies nearly 70% upside. So they do see a lot of momentum here.
Yeah, and the stock's only up about 4% this year. So it has not participated in some of the big gains that we have seen elsewhere in the sector. So something to keep an eye on. Finally, Netflix, firmly in Allie's wheelhouse. That company announcing a global brand partnership with AB InBev. Tell us about this.
Yeah, so this is the company behind Budweiser, Stella Artois, Corona. Financial terms weren't disclosed, but the scale of this is notable because AB InBev brands will show up across various Netflix titles, live events, from The Gentleman in the UK to Culinary Class Wars in South Korea. Plus, there's also those major broadcast deals with NFL's Christmas Day games and even the 2027 Women's World Cup. And it also just highlights the traction that we've been seeing in Netflix's advertising business. So the ad tier was launched roughly 2 years ago, now reaches more than 94 million global users, and it is seen as this growth engine for Netflix. And across the board, when you look at the momentum for the various subscription tiers, the ad tier has been cited consistently by the executives as a place where consumers continue to flock at a time when they're maybe a bit squeezed in other places.
So just to be clear, this is AB InBev going to be advertising on the platform. Is it also sort of product placement in the shows?
Product placement. And that's something that Netflix has been leaning into probably more heavily than some of the other streamers.
Yeah.
Let's find ways to incorporate your product into our live events. WWE, there's all these opportunities to have products and to have advertising front and center on top of the ad tier. So overall, they're just making a big push into advertising.
Usually the one I notice is Apple, shows on Apple.
Yes.
They're always using Apple products in lots of different ways. But yes, you're right. I'll be keeping an eye.
Yeah, keep an eye on the
buds on various Netflix shows.
Corona here and there on a show.
All right.
I'll keep my eye out too.
Thanks, Sally. All right, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, Yahoo Finance took a closer look at what has been pushing shares of Opendoor higher and the retail trading boom.
The CFO of Opendoor is departing, the company naming Christy Schwartz as interim CFO, effective at the end of the month. Schwartz has spent more than 8 years as the company's chief accounting officer, also serving as interim CFO in 2022. That was for nearly 2 years. Now, Opendoor, a lot more than the fundamental story. It's the latest meme stock to go crazy in this market. Went from trading below $1 back in mid-July and on Friday settling just under $10 a share. Joining me now to talk all things Opendoor and the state of the meme rally is Luke Kawa. He is the markets editor at Sherwood News. Luke, great to see you. Let's just start with the Opendoor story, and you've been covering this fairly aggressively. I'm curious what you make of the fundamental story at the company right now, which all kind of began with like, hey, it's $1. Hey, maybe it should be 10. Now we're almost at 10, and what the fundamentals are behind that. And maybe we can get into some of the meme stuff later.
So I think it's interesting in terms of the fundamental turn that you've seen in terms of the housing market. You do see some green shoots and things like mortgage applications recently and things of that nature. For Opendoor, a lot of the move or the expected turn in the housing market and housing activity has taken place well ahead of a change in fundamentals. In fact, in its second quarter earnings, it was able to book some positive EBITDA. Revenues came in a little higher than expected, but they did say the third quarter would come in a fair bit worse than analysts at the time had expected. So really the big catalyst for the stock has been the expected change in the fundamentals that the retail crowd very much hopes will happen under this new leadership, which includes a couple of the old co-founders and Shopify's old COO, Kaz Netjatian. So it's really a story much more of the fundamentals that people are willing to dream on, given the opportunities in the housing market more than it is something that has fundamentally positively turned. If you look at EV to sales ratios, it's pretty much a fair bit ahead of Compass. I think you can argue that arguably Open Door has more leverage to a positive turn in the housing market than Compass, but this is not a move that has happened yet on fundamentals. It's based a lot on expected improvements in the fundamentals.
Yeah, so let's talk about the expectations and the folks who have them. You had a great story this morning on Sherwood talking to a number of retail shareholders, individuals who own the stock, and kind of the story they're seeing. And I'm curious, from your perspective, now as a journalist, previously in money management, just the role that these things play within the market and how quickly it feels like you can get a large group behind an idea and they now have enough sway to actually see this thing through. It's just not a silly part of the market anymore. It's a real factor in kind of driving the daily flow and the daily, thought around where are we at, much more broadly than a name like Open Door.
Yeah. For instance, Goldman Sachs basket of the stocks that retail traders own the most, it's up over 13% in the past 10 days. It's on a 10-day winning streak for its first time ever. So this is not simply an Open Door story. But Open Door, what I think is very unique about it is the extent to which these flows have changed the fundamental picture. I don't think you get Shopify COO jumping back over in the event that you don't get a big increase in the stock price. I don't think you get the co-founders coming back to play a more active role on the board of directors unless you have that interest. So in talking with a lot of the retail investors, one thing that's really, really struck out is transparency, open communication. The fact is that the shareholders that have been aggressively buying Open Door down when it was at 50 cents, $1, $4, what they've been asking for, they have pretty much completely got. They didn't want the old CEO in. She's since resigned. They wanted Keith Raboy in particular back on the board, one of the co-founders. Mm-hmm. He's come back. They wanted an end to the 10B, kind of the automated selling programs that insiders had. Those have been taken out. So now it's like you have convinced and you have acted upon the wishes of the people who had the most passion and who were in at the ground floor. You've won them over, and they've been showing that they're willing to buy more on these positive catalysts. Now the question is, you still have to convince the rest of the world, and you have to do that both through putting it up quarter after quarter and by kind of showing some more headway in taking on what I would call, the three spreads that Open Door has to kind of attack. That's the spread between what they're going to buy homes at, what they're going to sell homes at, the spread of what they're effectively getting by trying to cut agents out of the equation, capturing that spread. Yep. And if they move kind of more into the mortgage financing space, well, that's the spread between what they're lending and what they're borrowing at.
And moving maybe a little bit away just from Open Door specifically, I'm curious what you make of the meme stock, that presence in the market today. I mean, you mentioned Goldman Sachs has a basket that tracks it. It seems to me it's just a more serious part of the conversation, and that these things do stand for something other than, like a lark. Like it's not, there's a lot of real money that is chasing these ideas, whether it is the playbook that Eric Jackson is running, or just this notion that you can get enough capital behind enough ideas around certain stories that you can create a real trade out of it. What do you make of the meme rally, the meme presence in the market? It just doesn't feel like it's going away. And how much of a sentiment barometer, let's say, sentiment barometer is it that you look at when you're thinking about markets on a day-to-day, week-to-week basis?
So I see really two things at play here. First is that I would emphasize when you think retail investor, you think someone perhaps with a limited net worth sitting behind or like making a trade or two in their brokerage account. Pretty much all of the folks I talk to who are very actively involved in Open Door, they are accredited investors by any other name. If they wanted to flip the switch, they qualify based on net worth, based on income. So these are real people with a lot of money. So I think that's one thing first that we should perhaps re-clarify how we think about retail investors when a lot of this is really kind of more akin to high net worth investors moving markets. So that's a starter. The second, I think you really, really cannot overplay enough the role of weekly options in the market in terms of being able to influence, drive, and precipitate bigger moves in stocks. So, for instance, a lot of the folks I talk to, they straight own the stock. They like the stock. But when the stock is getting a positive catalyst and it's going up, what you are really also seeing is, in addition to active buying of just the underlying stock, you see very, very aggressive buying of near and out of the money call options with an expiry at the end of that Friday. That has in itself a kind of positive reinforcement effect in terms of what it creates in terms of demand for the stock. So what I see in this is, like, yes, we now know by virtue of market structure that there are ways to have very strong, nearly self-sustaining moves up to a point. You kind of need more volumes and more interest to keep it going, absent positive turns in the fundamentals. But we know that this happens. I know that market makers are certainly aware of it in terms of how spreads have changed, even since the initial kind of GameStop 2021 episode there. So it's a feature of markets. And for me, it tells me that people are a lot more active in the stock market, and they're using it not only to kind of bet on turnaround stories through just owning the stock, they're also using it as a speculative device in terms of short-term gains, and that is pursued aggressively in the options market.
We've got the major indexes sitting near record highs, even the small cap Russell 2000. The S&P 500 alone has added $16 trillion in market cap since the April lows, and meanwhile, the Fed is cutting again. And earnings season is about to start. But one of the biggest supports for stocks is fading right now, the stock buyback bid. And that's what we're digging into on today's Stocks in Translation. First, a quick definition. A stock buyback or repurchase is when a company uses cash to buy its own shares in the open market. Fewer shares can lift earnings per share and also support the stock price. And it can also help offset any compensation paid to employees in stock. The buyback is a legal, common tool, but it does not guarantee gains. The first chart that we're going to look at, courtesy JP Morgan, shows how stock buyback announcements have been tracking this year in white versus the 3-year average in green. Notice how 2025 climbs faster and higher. It's only September, and we're already closing in on $1 trillion, which happens to be the end of year average. Also important, these are only announcements, not actual buyback executions, which we're going to take a look at next. This next chart by UBS shows the rolling 5-day buyback executions for 2025 in billions of dollars. Notice the rhythm. There are 4 separate waves per year, which coincide with each of the 4 earnings seasons. We're going to get to exactly why this is in a minute. Meanwhile, the dotted line shows where we are right now, and just to the right of it is an estimate for the rest of the year. Then if you look just to the left of the dotted line, you're going to notice how buybacks have recently dropped off quite steeply. This is because we are now in the buyback blackout window. This is a quiet period before earnings season when many companies pause share buybacks. They do this to avoid trading while they hold earnings results that are not public just yet. Some companies keep a small autopilot running, which is perfectly legal, but overall buyback demand, it drops noticeably. In this next chart from Goldman Sachs, we're going to zoom in on the current blackout window, which tracks mid-August through mid-October. The vertical axis tracks how many companies in the S&P 500 are in the window right now. The higher the number, the fewer the buybacks. And you can tell from the dotted line showing where we are right now that we're getting close to the peak, which extends into mid-October. This means the so-called buyback bid is shrinking, but should start building again as earnings results hit the tape and companies exit the window. The timing matters because September is historically the weakest month of the year. This chart shows the median gain or loss for each month in the year in the S&P 500 going all the way back to 1990. You're going to notice that only September tends to be negative. And remember, that's right about when the blackout window widens, which is right now. And although October is a good month for stocks on average, it's a month when historically we've seen a lot of stock market crashes and when volatility tends to spike. So just to recap, we are at record highs right now, the Fed is easing, we've got earnings ahead, but the buyback safety net is partially pulled back until results start rolling in. It just means a bit less cushion and bigger day-to-day swings. Here's what to watch out for next. Remember that the buyback blackouts, they peak in mid-October, then they lift. Watch out for the buyback bid to return as earnings season shifts into high gear. Then, as results roll in, you got to pay attention to companies updating their share repurchase plans. And also watch out for spikes in the VIX volatility index, which tends to get bigger into September and October. A higher VIX usually means weakness in stocks. And also, you might keep an eye on long-term government rates. A big jump, they can take bites out of stocks and kind of hit them harder when buybacks are light. So the bottom line is, for the next few weeks, the market's biggest consistent buyer is mostly on the sidelines. So a little caution is warranted as we celebrate all these record highs. And tune in to the next Stocks in Translation, the podcast, for more deep dives into markets. New episodes can be found Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcast. Stay tuned for more market catalysts up next.
It's time now for our investor playbook, looking at software stocks. Joining me now is Steve Koenig, Macquarie U.S. Head of Software and Services Research. Steve, it has been an interesting year in software land, to say the least. With AI coming in more strongly, there have been a lot of questions about which companies could benefit, which might be eaten by AI. And then in the background, all of that is bubble talk as well. And that was the subject of a recent note that you put out. Are we in a bubble there? What do you think?
Well, good pointed question, Julie. And I think some of the indicators that we look at that point to like risk on, risk off, or investor preferences for growth over margin are at like 24-month high levels in terms of that preference for growth and risk on. So that said, I think we want to be, maybe exercise a little bit more prudence at these valuation levels. But there's a lot of great revenue momentum going on in software now, and certainly a lot of investment dollars are flowing into anything AI related. So, that's kind of the backdrop, and I think investors want to stay prudent, and a stock selection remains very important. But I think that software is a great place to make money, and averaging it over time is probably a great way to go.
Agentic AI seems to be the buzzword of the moment. Is that where investors should be putting their dollars?
Yeah.
And where are we in that? Or is all agentic AI created equal?
Yeah, well, great questions. What's interesting is we did a report on AI disruptors in software. And if you look at the top 60 private companies, software companies, they're all AI native. They're all focused on AI. The large majority of that is large language models, it's platforms, it's tooling, not so much agentic AI. However, if you look at what public large SaaS companies are doing, the large majority of their product efforts are around agentic. So there's a little bit of a dichotomy here. And I think what's happening is the public companies, they are looking to protect their application moats, if you will. They're looking over their shoulder. They don't want disruptors to come in. And there are companies on this private list that are focused on agentic AI.
Is it going to work?
Yeah.
That attempt to protect their moat?
Yeah. Well, I think to the extent, I think the big question right now is, how fast is agentic AI going to get adopted? I think in the near term, most of the adoption is going to be driven by the public SaaS companies that are putting this stuff out there for their customer base. But this stuff is taking time, and that's what investors are realizing as this year has progressed, is like, there was a lot of hype around agentic AI, and the technology is promising, but there's a lot of hurdles. Customers have to get their data in order. Customers need to make sure that these autonomous agents are operating accurately and not hallucinating. Mm-hmm. And so all of this is taking probably more time than investors initially thought. I think to the extent that agentic AI gets adopted, and I think that will happen, I do think the large public companies, at least for the next several years, have the advantage here.
So let's talk about some of your picks. And it's interesting when you talk about moat, because Autodesk stands out to me on that front. We actually just spoke to the CEO of the company recently when they had introduced some new products. Design software company for architects and people doing projects and things like that. Is that why they're on your list?
That is one of the tenets of our investment thesis. I think the opportunities for them in applying generative AI to the design process are really very unique and something different than most of the large SaaS companies deal with structured data. Whereas with design, you've got multimodal inputs, and the idea of having a product designer or an engineer or an architect use text prompts to define the idea and then to use a multimodal model to flesh out that idea in terms of the building or the product. It's really a unique opportunity for them to apply AI. So we do like that. But beyond that, I think our investment thesis with Autodesk has to do with the fact that we think there's lots of room for margin expansion for them. Their move into downstream construction, into software for field operations is going very well. And I think that they're going to be more focused than ever on getting relationships established directly with end customers as they're changing their transaction model to sell directly to the end customer rather than through resellers. And that creates cross-selling opportunities and opportunities to run sales and marketing much more efficiently.
And I would imagine to capture more of the revenue as well.
Yes.
Datadog on your list as well? Tell me about that one.
You know all my top picks, don't you? I think
I do.
you've done your homework.
I read the note.
That's great. That's great. So we like Datadog. Really it has to do with their market position and share gains in DevOps, and in particular, it's called observability is their category, and it's really about helping software developers and tech operations when they're putting into place new applications, assuring that those applications perform properly. And so Datadog kind of created this market for the cloud. There were kind of legacy on-premise vendors, but Datadog pioneered a unified platform for cloud observability. And they've been gaining share in that market. And that market grows very much in tandem with hyperscaler revenue, which has really had been decelerating, but really has stabilized around 15% growth. And then you add to that Datadog share gains, they have a great revenue growth opportunity.
What I think is interesting, of your top 3 picks, and Atlassian is the other one, the team is the ticker.
Yep.
I believe HubSpot was on your list of top like a month or 2 ago.
Yeah.
Is that not, do you still like that one, or is it just that you like Datadog better?
No big message there that HubSpot was not on the list of top 3. It's like we try to look at what's timely at the moment. And I think that HubSpot has some nice drivers. I think their paid seat expansions have been under pressure, but I think that that's starting to improve. And then I think that they're actually handling their agentic AI strategy well, and I think that will be well received by customers over time. So we still like HubSpot, but in terms of some of the near-term drivers, we like Team and Datadog and Autodesk are the 3 that we want to focus on right now.
Gotcha. Yeah. Steve, great to see you in person. Thanks for coming in.
Likewise.
Appreciate it. Well, that's it for Market Catalyst. I'm Julie Hyman. Thanks for watching. We got more Yahoo Finance coming up.